Bloomberg Audio Studios. Podcasts, radio, news.
Robert Kaplan with us right now is affiliated with Goldman Sachs and, of course, his public service at the Dallas Fed. This is great. I thought Austin Goolsby's dissent yesterday was really something with his technology bent, his work out of MIT at Chicago. Now, my own individual opinion is Goolsby's something really worth watching here. Mark Wynn is out of Ireland in Rochester, has a shingle out at the Dallas Fed. And of course, Mark Wynn, under your student guidance years ago, has a spectacular essay out on AI. And the summary of Mark Wynn's work is, we just don't know, do we?
Well, I think we're in the early stages of AI adoption. Most of the talk about AI right now is about the infrastructure build, but that's different than the downstream adoption. We're in the first or second inning. I think my own view, and I think the view of my firm is, when we talk 5 years from now, we'll see a 0.5 percentage point gain in productivity growth for GDP. And it will help business. But which use cases work and which don't, we're going to spend the next 3 years trying to figure that out.
Net, is it positive for the economy, and how material? Because a lot of folks are hanging their hat on AI as really being a productivity enhancer to really impact the economy.
If you got a 0.5 percentage point jump in productivity growth, that's a huge deal.
Yep.
So we have sluggish workforce growth in the United States. We don't have much immigration at the moment. A bulk of our GDP growth's got to come from productivity growth.
Yep.
So AI is very important to the world and to the U.S. And yeah, 0.5 percentage point would be a big deal.
What'd you take away yesterday from the Fed meeting here?
Pretty straightforward. I think that in the room there was a lot more disagreement than it may have looked like. Only a couple of dissents, but we're at or near neutral. I think Jay Powell even said that. It confirms that I think the neutral rate nominal is about 3.5, 3.75.
Okay.
And some of the folks say with inflation at 2.75 and the job market likely to firm in the next year, we shouldn't be at neutral. And I think overall they bought insurance in case the labor market's weaker than they thought. But from here, it will be a conventional Fed, meaning something's got to change to move the rate. Either unemployment needs to worsen or inflation needs to improve.
Across the nation, Robert Kaplan with us of Goldman Sachs, his former service at the Dallas Fed. So we say good morning to Texas as well. So I look at yesterday's meeting and I look at all the what ifs that are out there. And the bottom line is a dual mandate. And I kept hearing a back and forth on the dual mandate. What's the history that you studied of whether they focus on inflation or jobs? And don't tell me both, because it's really hard to do that, isn't it?
Well, for a lot of the last 10 or 15 years, the Fed had the luxury pre-COVID of not having an inflation problem, so it could focus heavily on what was going on in employment. And if thought employment was weakening, it could move. Post-COVID, and I would argue with this boom in government spending we had in 20, 21, 22, and 23, and which probably caused supply chain dynamics to create an excess demand issue, they got to deal with both, and it's harder to deal with both. And so then they have to make trade-off decisions, and that's hard to do. Having said that, I think they've done a reasonable balancing job. But that's the reason for the division in the group. It's not that they prioritize one over the other. I think the fact is we've had three headwinds. One, in the short run, tariffs are slowing growth. The immigration policy has slowed growth. And the shutdown, as you would expect, has slowed growth. But the shutdown is reversing. And going into 26, we're going to have tax incentives. We've got this AI boom continuing. And I think the economy is likely to firm. And you saw that in the dot plot. And people are saying, the labor weakness is going to firm. Let's do nothing. And that's the reason for the debate.
Interesting. When you talk to your corporate clients at Goldman Sachs, what is their view for 2026? We're seeing, I kind of look at M&A as a barometer of how confident the C-suite is and the board is. And we're seeing a big M&A trade going crazy out there with Warner Brothers Discovery. When you talk to your corporate clients, are they confident about their ability in 2026 to maybe grow?
I think most companies believe, as we do, that 26 you'll see firming GDP growth because of tax incentives and other reasons. However, I've never seen a period in my business career where there wasn't a bigger concern about the need for size and scale to afford the technology investment.
And
that's driving a lot of merger activity.
We've covered this a number of times this week as well. So then do we head towards a monopsonistic America? Do we have a capitalism that is essentially a big roll-up to get to CapEx scale?
I think you're going to have lots of still small emerging businesses powered by AI that can grow and will be very attractive, and they'll get to a point where they kind of stabilize. You'll have lots of very big, huge scale companies that are dominant, and you're going to have a lot in between. And I guess the way I'd say it, in between has gotten a lot bigger in the last. Companies that used to think they were big and dominant and still are less dominant.
I looked at Procter & Gamble carefully, so I don't want you to comment on an individual security. But what does old industry do in their in-betweenness?
Build size and scale and make more investment in efficiency, productivity, technology. And so all that costs money, and in the short run reduces margins. And that's why you also see a lot of belt tightening right now to offset some of the margin impact.
One of the newer developments, capital markets-wise, over the last 15 years has been private credit. What's your view there?
I mean, we tend to view it as a private credit. I'd say has been a good addition. Mm-hmm. It's been a good addition to bank lending. The only comment I would make, on the other hand, is investment grade credit spreads are very tight, but it's investment grade. I think the watch out is the less than investment grade side of private credit. We haven't had a credit cycle in many years. We're not going to have one, I don't think, in 26. We'll have one eventually. And so there's a lot of money flowing in to less than investment grade private credit. I'd be careful about that.
Robert Kaplan, thank you so much. Greatly appreciated. Of course, the former president of the Dallas Fed and with Goldman Sachs now, and of course, an affiliation with Harvard over the years.